What happens to your money and investments if Trading 212 or any investment platform goes bust? Would you lose everything? And what if all your investments are with just one broker? With more people investing through apps and low-fee brokers like Trading 212, Invest Engine, and Free Trade, is a question I get asked all the time. In this video, I'm breaking down what really happens if your broker goes bust and what you can do to protect your money. Hello, if you're new here, I'm Chioma. Today, we're tackling one of the biggest fears people have when investing through platforms like Trading 212. What happens if the platform itself goes bankrupt? When you invest through Trading 212 or any FCA regulated UK broker, your money and investments aren't just sitting in their company account. Your uninvested cash in ISA or invest accounts is held in a ring-fenced client money bank account and protected up to £85,000 by the Financial Services Compensation Scheme (FSCS) in the UK and up to €100,000 in many European countries. That means your money is completely separate from Trading 212's own funds. They legally can use it for their own trading or operations. It's pooled together with other customers' money but is ring-fenced and protected. To reduce risk even further, Trading 212 spreads this money across major banks like Barclays and JP Morgan. So even if Trading 212 goes bust, your cash should still be safe and accessible. You will notice I've been saying uninvested cash. That's because if you've opted in to earn interest on your cash, it's no longer uninvested. Most platforms, including Trading 212, use qualifying money market funds to generate that interest. While these are considered very low risk, any cash moved into them is no longer covered by FSCS. So you may get higher interest, but you're also giving up the government guarantee on that portion. Now, for your investments like ETFs or shares, these are held in custody, separate from the platform's own assets. You're the beneficial owner, even though the shares are registered in Trading 212's name. Trading 212 uses a global broker called Interactive Brokers to safeguard your assets, and that relationship is governed by strict UK rules under the FSCS Client Asset Sourcebook or CAS. This means your assets aren't on Trading 212's balance sheet, so they're protected if the company faces financial difficulties. While Interactive Brokers is a highly regulated firm, it does add another layer to the chain. If anything were to go wrong with record keeping at either end, it could cause delays or errors. That's why it's a good idea to keep your own records of what you hold, just in case. We're not diving into the risk of third-party custodianship in this video, but it's something to be aware of. So let's say the worst happens. Trading 212 goes bust. What actually happens to your money? If there's no platform taking over, administrators will step in to begin the process of returning your money. It might take a bit of time, and there could be some small deductions for admin costs, but as long as proper records are in place, your money should be returned. Now, when it comes to your investments like shares or ETFs, the administrator arranges a transfer of your investments to another regulated platform, unless you choose where to move your shares. But if anything went seriously wrong, say mismanagement, fraud, or administrative failures, and your money and assets couldn't be recovered, FSCS protection could kick in up to £85,000 per person and per firm. So while it might be stressful, your money and investments don't vanish. The system is designed to protect retail investors like you and me. In fact, I've experienced something similar when Hargreaves Lansdown went through a major takeover, and honestly, I didn't feel any difference. My investments stayed where they were and everything continued as normal because the assets were properly safeguarded. Now, here's another common worry. What if the actual company I invested in, like Tesla or Palantir, goes bust? In that case, you're not protected by FSCS. If the company fails, you lose your investment. That's the investment risk you take when buying stocks. This is why diversification matters. You don't want all your money in just one or two companies. Trading 212 is regulated. You've got FSCS protection, but is it safe to have all your money with just one platform? Technically, yes. There's nothing stopping you, but from a risk perspective, probably not ideal. Even regulated platforms can run into issues like service outages, trading glitches, or just features that don't meet your needs later on. That's why many investors diversify across platforms too, not just assets. For example, you might use Trading 212 for your ISA and hold your pension with someone like Vanguard or AJ Bell. If you're a subscriber, you know I personally use more than one provider and I only keep a small portion of my portfolio with Trading 212. This isn't financial advice, but if your investments are starting to grow, it's something worth thinking about. As long as you're using regulated platforms and understand the rules, investing through apps like Trading 212 can be very safe. Just remember, platform failures are very rare. Losing money on a bad investment is a much more common risk. Now, check out my Trading 212 review. If you found this helpful, give it a like and subscribe for more investing content every week. And let me know in the comments, do you stick to one platform or do you spread your investments? Thanks for watching. I'll see you in the next one.